The new rules issued by the IRS are changing the way that you take your required minimum distributions from inherited IRAs. Now, required minimum distributions, or RMDs, are the amount of money that you need to start taking from your retirement accounts after you turn 73. So to break down what you need to know, we've got Joel Dickson, who is the Vanguard Global Head of Advice Methodology here. So let's just give people the lay of the land here. What is the current status quo, some of the rules around making sure that once the IRS rules take effect, that they are removing the right accounts from these IRAs?
Yes, well, Brad, thank you for having me today. This has been a topic long in coming, if you will. The discussion really started back with the so-called death of the stretch IRA back at the end of 2019, which meant for most non-spouse beneficiaries, you had to accelerate the amount that you were taking out of the inherited IRA, kind of within a 10-year period. But exactly how that was going to occur was not certain. And so we've been waiting on these new rules to understand exactly what needs to be done. And basically, for most non-spouse beneficiaries, you are going to have to accelerate your drawdown of the IRAs relative to what had been happening before.
It seems like this would naturally have a negative perception. What is the real perception that you've heard and seen from clients?
Well, certainly everyone thinks, hey, the longer I can keep money in a tax-advantaged account and avoid the tax bill associated with such elements, the better off we will be. However, that's not necessarily the case. And in fact, there's a silver lining to these new IRS regulations that requires maybe a greater acceleration of that money, which is that if you can avoid large distributions putting you into higher tax brackets in the future, it actually can make some sense from a total tax paid standpoint and even a total wealth standpoint to actually take distributions from an inherited IRA, maybe even more quickly than the IRS regs suggest. But certainly the IRS regs help to mitigate some of the risk that distributions in the future, if you were to just defer those distributions as long as possible, could force you into higher tax brackets and actually provide lower after-tax wealth over time.
What would be the advantage, or what's kind of the rule of thumb on if you should be drawing down even more than the threshold that is required?
Yeah, the main thing to look at, and it gets a little complicated, and so working with a financial or tax advisor may actually be useful for your individual circumstances. But there are many cases, and we see this with normal required minimum distributions for your own personal IRA, say in retirement, where the distributions could be large enough to push you into a higher income tax bracket, which means the money that you're receiving from that distribution is taxed at potentially a higher rate than normally you would be subject to. And so you can smooth that out over time by managing distributions more carefully over the life of, let's say, your retirement, or in the case of inherited IRAs, maybe spreading them a little bit more equally over the 10-year period over which you have to distribute the IRA.
Joel Dickson, who is the Vanguard Global Head of Advice Methodology. Joel, thanks so much for taking the time here with us today.